So here's a few takeaways. So, and again, I think if you just remember these things, you're going to be ahead of 90% of the option traders out there. So IV is just a proxy for market risk, and it's derived by supply and demand and perceived risk in the market. And the demand increases when historic volatility increases unexpectedly, like yesterday. We had an unexpected drop, or I don't know how unexpected, but it went down a lot fast, right? And so IV went up drastically. So everything is, in terms of pricing, went up yesterday, today, based on yesterday's movement in the stock market. And the IV can be used to calculate the expected range where a stock's going to move. And so if I'm looking at like a put spread, what I'm looking at, one of the factors is what's the expected move in the next 2 weeks. We want to be below that, right? So we don't want to be, we want to use that to our advantage. And and the normal distribution of one standard deviation is 68% on for the total, meaning 16% on each side. So so that's kind of the standard deviation. And the book also shows that in actuality, it's always kind of skewed to the positive if you trade like a 16 delta strangle. So it's kind of like we're the casino, and we have the advantage based on the fact that we can sell using probabilities on our side. And so, again, historic data shows that stocks stay within this expected move. And sellers of option, this is probably the key thing. Sellers of option have a long-term advantage over option buyers. And the reason for that is, in order to be profitable buying calls or buying puts, we have to be right in not only the direction that we bet, but also how fast and how much it moves. So say, for example, we buy calls in Apple, and Apple's at $150 a share. So we buy the 150 call and we pay $5 for it. In order for us to make money, that stock has to move more than $5 before our expiration. So not only do we have to be right in the movement, but right in the timing. Where selling credit, we just have to not be dead wrong. And the other thing that's interesting is that every stock or ETF has its own volatility profile. And that makes sense, right? If you're trading NVIDIA versus Procter & Gamble, they're going to be different. They're going to act differently, right? So, but they all have expansion and contraction. So, so that's another kind of key factor, is that, just because a stock doesn't historically have super high volatility, it still can be traded because it will expand and contract and revert back to the mean. So